Hello and welcome to the podcast today. My name is Steve Bajalia, and we are here at Redemption Financial Services. I'm here today with Jerry Perminer, longtime friend of mine, and owner of the Debt ER. It's a company that helps with debt solutions. And today we've decided to put together a podcast regarding questions that people commonly have about debt. So Jerry, welcome to this podcast.
Thank you.
How long have you been working in the debt industry?
I would say for the better part of 37 years.
Okay, awesome. So you could say you're a vet.
I would say that.
Yeah. So what purpose are is this for what purpose is this conversation?
It's going to be centered and focused around consolidating unsecured debt, Steve.
Okay. So consolidating, I hear this word all the time, consolidation. What is debt consolidation?
That's a commonly misunderstood term, but what it is it's the opportunity and the ability to consolidate or bring together unsecured debt into one particular option to deal with instead of multiple payments to credit cards and loans separately. What it does is it condenses your debt portfolio to an option.
So you basically would take five or six accounts or four accounts and put them into one account.
Correct.
Okay. So there's multiple paths to consolidate. It sounds like.
Mm-hmm.
How many paths are there?
There's only four paths that one can take in order to properly deal with consolidating unsecured debt, Steve.
Okay. And so, what is the most popular one? The one that everybody wants for consolidation? Which one is that?
Well, I chuckle a little bit because the majority of the folks that are, searching for options tend to look at borrowing money or a loan, getting into more debt. But it would be a loan product, Steve.
Okay. So, out of the people that you and your partners talk to, is it a vast majority that are looking for this loan?
I would say there's probably a 60-40 split. Some of them have gotten information advice from a friend, a family member, probably surfing on the web, looking at how to deal with unsecured debt. Many people do that.
Yeah.
So it's often that they'll conduct their own research before actually reaching out to get
Okay.
some professional help.
Okay. Now, when people call you and they say they want a loan to consolidate, what's the percentage of people that are qualified for that loan?
Well, that's a great question, Steve. And to properly address that, the percentage of people that qualify for a loan are folks that really don't need a loan. They have excellent credit. Their credentials are there, which are required, much like it would be if you went to your bank or a
Yeah.
local lender or even a lender on the internet. The requirements are going to be quite high, especially in these times. The credit needs to be above average. The income's got to be there for at least a year, well-established income, in order to qualify or even get for us to pre-qualify you for a number of loan products. The dollar amount.
So does your because I hear this term all the time, DTI, right? Your debt versus your income or debt to income ratio. When they look at a loan application to consolidate your debt, are they looking at your debt to income ratio?
Well, when you say they, these are going to be your lenders and your banks, or the
Yeah.
people that that are going to provide that service. And yes, they do, Steve. You when if think of yourself as a lender, and if you were a bank manager or you had money to lend, the first thing that you need to understand is, can they repay that loan? What is
Right.
the likelihood that they can repay that loan? How established are they? And these are equal a trust factor, if you will. In the banking world, it's a model, a score model that's being used, such as a Beacon score or a credit score.
Mm-hmm.
But your debt to income ratio is important because it tells you how much income that you have versus how much debt that you are now going to be obligated to pay for, and what you have already obligated a portion of your income to pay for. Generally speaking, on the high end of things, less than 30% of your DTI would be a someone that would be a prime consideration for a loan product.
So if you're struggling with credit card payments, not even struggling, but you're making the credit card payments, but you're not able to save very much money in your checking account, would you say it's pretty likely that you're not going to get approved for a loan anyway?
That's a good question. The best way for me to answer that, Steve, would be, what are your goals? What are you looking to accomplish by borrowing money, more money? Borrowing money to pay off money that you already owe. Now, typically they're just personal loans, that are used to pay your creditors directly. So it's not money in the pocket. Like many people, that I've talked to, Steve, often they'll say, "Hey, I need X amount of dollars, but hey, I'd like to have a little extra cash for me too." That's not the way loan consolidation is designed or set up. It pays the
Okay.
creditor directly, which is commonly misunderstood. I mean,
Wow.
right now the average interest rate, Steve, is going to be 18 to 21%. So let's
Wow.
think about that for a minute. If you're looking for a loan to pay off high interest credit card debt and maybe some other loans, best case scenario for people that are qualified or even overqualified, I like to say, is going to be 18 to 21%. So if you think about that over the course of 4 years, it's likely you'll pay the better part of twice as much to
Wow.
borrow that money in a 4 year time frame.
Wow.
Credit cards offer a very long time to make payments, although the interest is much higher. People see that as a convenience. It's kind of the payments out of sight, out of mind.
Yeah.
They set it on auto pay, set it and forget it. And then, of course, later when things change financially, then, it brings to the forefront, where's my money going? So a loan product gives you the ability to consolidate, if you will, all of the debts that you have that you're making multiple payments on, consolidate the multiple interest rates that you're being charged into one payment for a short period of time.
So it sounds like from the outside looking in, a loan product will consolidate your debt into one payment. It's going to be the same payment every month versus having multiple payments with multiple interest rates. The interest rate sounds like it's just as high as a lot of the credit cards,
Mhm.
but they give you less time to pay it.
That's
Now,
right.
now I've heard this said before that if you get a consolidation loan, you're basically adding debt to your debt. Do
Yeah,
you find that to be the case?
I do. Um, Professionally speaking, um, you're borrowing money to pay off borrowed money. You are compounding the problem. And unfortunately, with revolving debt in particular, Steve, as I said earlier, you get a much longer term for a smaller payment. You are now taking a 10 or 15-year term, depending on the balances, average balance of around 15,000. You may have 15 years to pay a credit card back, whereby you now have condensed that into a 3 or 4 year loan product and program, so that typically will increase the amount of money that you have to pay each month, rendering you debt free within a much shorter period of time at an expense.
Got it. Got it. So I've heard this as well. When it comes to these personal loans, what's the difference for our audience to know? What's the difference between secured and unsecured debt?
Great question. This is a question that we often have to explain to the consumer. Secured debt is debt that is associated with, rather, personal property. A good
Collateral.
example would be an automobile loan, a boat, a trailer, even household items. But something that you would purchase where there is collateral, or the loan has been collateralized by virtue of a product, a tangible item.
Okay. Okay, good. So,
Unsecured, of course, would be the quite the contrary. It would be you sign on the dotted line. There's no property in question to forfeit,
okay.
and you are now being trusted by the bank to repay that money according to the terms.
Okay, awesome. So I hope that helps everybody understand secured versus unsecured debt. Now there's somewhat of a there's this I see ads sometimes where people say or companies are putting out there that there's grant or free money to take care of debt, whether it's for veterans or senior citizens
Mhm.
or whatever group that they're advertising to. And I know that over my career, I've seen people talk about looking for a grant or free money. Can you talk about, have you seen that? Is it your experience that you've seen grant money, and where would people get that?
Mm, that's a tough question. And the reason that I say that, Steve, is pre-COVID, during COVID, the federal government did a number of things to reinvigorate the economy by offering federal money, quote unquote free money. They even stimulated the economy, if you recall, for
Yeah.
small businesses to start a business. You know, the American dream. Those days are gone, as is COVID. And so free money and the access thereof is simply non existent. That is probably one of the biggest misnomers that we come up against on a routine basis, where someone is looking at a ad that is not necessarily misleading, Steve, but they're not reading the full bullet points on the ad, and all they can see is free money.
Yeah.
So in their mind's eye, there's free money. I don't know of a single human being that wouldn't love to have free money. Um,
Yeah, it's
and
true.
I'd love to be able to do that for them. You
Yeah.
know, it would be a blessing for us to have, a wealth of resources, financial resources to pay, to help these folks financially. But unfortunately, that is not true.
So, as far as you know, right now, in the current economy that we're in 2024, there is no corporation or business or government entity that is paying off American consumer debt either by grant or other means.
Absolutely correct.
Okay, awesome. It's good to know that. That's, I know, one of the biggest questions that we come up against. So the next avenue, you said there was four paths to take. The
Mhm.
first one being the consolidation loan. What's the second one?
The second one's going to be a what we like to say credit counseling or debt management product. These programs, Steve, really work to reduce your interest a bit and kind of combine the payments, quote unquote, consolidate payments. So that keyword consolidation comes into focus when you're dealing with debt management or a consumer credit counseling program.
Yep.
These are go back decades. They're not a new thing. But now they're being more recognized because there's more people suffering financially in this current economy than what, say, 5, 6, 10 years ago. So they don't offer a lot of payment relief. They're for smaller debts. We tend to recommend the credit counseling product to folks with less than or not much more than $8,000. Right around there, that's kind of the medium or where we like to see where we draw the line is in terms of making recommendations. We don't tend to recommend that option very often because most of the folks that are responding to us are, well in excess or in excess of 10 to 15,000 in unsecured debt.
Okay. So basically, with credit counseling or debt management, what they do is they consolidate. You're saying they consolidate your payment into one smaller payment.
Mm-hmm.
I know that these programs have been around a very long time and have worked, but they also take a long time because of that smaller payment. Is that right?
That's a great point. It's one thing that I missed is they take an enormous amount of time. They could go on for decades. You can compare it with making the minimum payment to a creditor and doubling up the payments to reduce the length of time that you're in debt with that creditor, or you can put it in a debt management consumer credit counseling program for an extended period of time. You'll get a little bit of an interest break, but you're in debt for a very long time,
Okay.
most
So
often.
the pros of a debt management program is that you will reduce somewhat a little bit of the interest, usually reduces your payment, but ultimately the cons of it is that it takes a very long time, almost as long as it would just to pay the minimum payments to pay it off.
Correct, Steve.
Okay.
You have to think about the goals that you have. Again, everything that we do is goal driven. Everything that we do, we need to understand what are you looking to accomplish? What is your goal? So when you're looking at debt management, It does not give you any control over how long you're in debt or out of debt. It's simply a program that's designed to reduce the interest. Thereby, you will see the impact to your principal amount owed become less than what you would do if you were just studied the course and made the minimum payments on a credit card payment.
Got it. Got it. Amen. So that's debt management and credit counseling. What's the third path you can take to consolidate your debt?
Well, this is going to be probably a debt resolution, consolidation through a debt resolution, quote unquote settlement option. Dollars and cents, Steve. What we're seeing today, it is our opinion and observation that this is hands down is going to be the best option for dealing with this specific type of debt. Um, you typically see your debt amounts cut in about half. That's eye opening. In addition to that, your monthly payments are usually cut in half, if not more. And this is where you're going to get the financial relief, immediate results by having the ability to put money aside for an emergency fund or maybe even to pay utility debt or common household debt month over month that you can't afford to pay now because you have so much credit card debt and unsecured loan debt.
Okay. So with debt settlement or debt resolution, you're able to lower your monthly payments. What does it do to the interest? I know debt management, you said it reduces the interest. In debt resolution, how much interest are you paying?
That's probably my one of my favorite things to reveal to our clients is there is no interest.
Wow. So no interest in debt resolution.
Correct.
And you said half your principal that you owe. So if I owe $20,000, then they would cut that down to $10,000.
Well, being non-specific because some there's a little more, some a little less, depending on the creditors. It's a well balanced option that can ebb and flow or vary depending on who you owe and how much.
Generally.
Generally,
So
but in the as a law of averages, if you owe 20,000, you can expect to settle or pay for roughly 50% or $10,000. So that would be correct to assume.
wow, that's awesome. So
Mm-hmm.
sounds like the benefits of debt resolution and debt settlement is that you have no interest to deal with and you're
Mm-hmm.
saving a ton of the principal amount, which I would assume cuts down on the amount of time that it takes you to pay back. What is the time frames that you generally see in a debt resolution program?
You know, that's kind of a twofold answer to that question. Number one, generally 4 years, 3 to 4 years, on an average of 15 to 20, 25,000 in debt.
Okay.
You can expect to be in a program with an affordable payment, cutting the principal in half and the payment that you're making currently in half, but reducing the time from 10 or 15 years to 4 years.
Wow. So you're saying basically if I owe $20,000 and I'm paying $500 a month, that I would expect to see something in the ballpark of saving $10,000 in principal, not having any interest, which leads my payment going from 500 a month to around 250 a month. Is that what you're saying?
That would be correct.
Outstanding, outstanding. So, what is the cons of debt resolution?
There's always the good and the bad.
Yeah.
Um, and I appreciate you asking me that because um, ultimately that's what people want to know. Give me the bad news. You know, this, I get I often will get the statement, Jerry, this is too good to be true.
Yeah.
And in fact, it really is, but it's true. It's good and true. The cons are that you have to make a conscious decision to stop paying the creditor your monthly payments. Um,
Why?
Great question. If you look at it from a creditor standpoint, if they can collect um, super high interest over an extended period of time, they're in the banking business, and long term high interest is where the money's at. If you elect not to make the payment and go behind on your debt, then a number of things happen. Number one, the creditor realizes there is a hardship or something has changed and you're no longer making the payments on time. What happens is if you don't give them the money, they can't put it in their pocket, Steve. If you continue to make the minimum monthly payments, you'll be in the debt, nothing changes. Um, and there's no option, there's no benefit.
So if you are electing to not pay your payments on time so that they could negotiate your debt or settle the debt, what happens to your credit?
That's one of the other downfalls to this is your credit does in fact take a short-term hit, and I'm going to use the word short-term. Really depends on the quality of the industry and the company that you choose. There are the top five or top 10, like you would in a sports environment or any other competitive environment. You have the people at the top that are accredited, that have a long-term history of success. These folks are the ones that we tend to work with. We have partnerships with, and they do the best job. So a lot of the stuff that we're talking about here, you would in fact experience by enrolling into that program through
So
the service.
it sounds like even though you're going to save half of your principal amount of your debt, so saving 10 grand on 20,000, and your payment being cut in half so you can have a savings account again and not having to deal with that endless interest, but you because you have to stop making payments so that they can negotiate that debt, it's going to affect your credit for a short term
Short term.
while you're in there.
Short term, I mean, usually, and I will say this as a matter of experience, and for your audience, those terms, you can begin to see credit improvement or stabilization in your credit score, often within 6 to 8 months in some of the top three or the top shelf programs that are out there.
Nice. Okay, so it's a short term thing. It's while you're going through the program. Okay, that makes sense. So it sounds like for most people, and you said this in the beginning, dollars and cents debt resolution or debt settlement is the best program for somebody with 20,000 or 15,000 or more in debt. Um, it just really depends on which company it would benefit them because there's probably quite a few that do it.
There are many, probably more than I can mention, but there's only a select few that are good enough to achieve accreditation through the American Fair Credit Council. It's almost like the a Harvard type degree, stating that the consumer is put on the forefront and that consumer protection is at a premium, and that there are stringent rules and auditing practices and processes in play to keep that industry honest. And then you've got the other folks that are pretty much at will. They're operating at will.
Yeah. So you have your small guys, and then you have your ones that are under the magnifying glass of the regulatory companies. Got it.
Agreed.
Okay, cool. So we've gone through three of the four so far. What's the fourth path you could take to resolve $20,000 in debt?
Well, there are on rare occasions those that may need to look at a bankruptcy.
Hmm.
There are two types of bankruptcy to look at. And there's a huge misunderstanding with bankruptcy. It does work for folks that are in a rather desperate situation. Let me give you an example. Someone that's on a fixed income. Maybe they've lost a loved one or their income has now been reduced significantly, and they were making an attempt to pay their creditors, but there's just no financial way or opportunity for them to achieve making those payments and surviving month over month with overhead. It's unfortunate, but there are those that really need to look at and consider bankruptcy. The two types are going to be a Chapter 13, which is essentially it's a restructuring of your debts. It's pretty invasive. Both bankruptcies can be rather invasive process. You're going to have monthly payments that are set up by a trustee, and you're repaying. You're filing bankruptcy, and you're seeking protection under Petition 13. But the difficulty is a trustee can raise your payments, and I'd say, Steve, about 70% of the folks that that we've seen through our research um, have failed. They wind up not being able to afford a restructuring bankruptcy, and the dangerous thing about that is these folks are totally exposed. There's no legal protection when you can no longer afford to make a restructuring payment through a bankruptcy petition, and you have no protection from your creditors.
What about assets like having a car retirement assets,
Mhm.
home. When you file a 13 or 7, either one, do they take a look at your assets at all?
Most definitely. You can't have $1 million in the backyard of the bank and go in and file bankruptcy because you don't feel like paying your creditors, Steve. So
Yeah, amen. But what if you had, like, say you had a truck, right, and you paid the truck off, and you got $10,000 in equity in the truck? Is it like, because I've heard these questions before, but is it
mm,
likely that a trustee would see that 10,000 in equity and say it's time to sell the truck and pay back your creditors?
good question. We get that a lot, and that's the fear, if you will, the common fear in bankruptcy. And to properly address that, although we're not giving legal advice, we're not bankruptcy lawyers, of course, but 35 years of experience, accounts for the observation being most bankruptcies and almost in most states will allow you to have to keep and manage your main mode of transportation so that you can function in society. You can keep your dwelling, your home is typically protected by from bankruptcy or from creditors approaching that. So you can keep your main residence
Mm-hmm.
and your main mode of transportation. If that truck were an asset and you own a garage full of special vehicles, or you've got in excess of, then the trustee is going to, in bankruptcy, the creditor will question the fact that that asset could be used to liquidate to pay their bill.
Mm, wow. So when it comes to, I'm sure nobody wants to file bankruptcy, right?
That's true.
Probably nobody wants to have their credit hurt in the debt resolution program, right?
Yeah,
I would
that's true.
assume most people don't want to go 10 years in the debt management program, right?
That's also true.
Right. So, and then when it comes to the loans, when they see that it's 20% or 18%, they likely don't want to do that either. But do you find that most people want to go the route that best suits their situation?
Um, Well, perception's reality, Steve, and when you make up your mind on a certain pathway that you want to take, it doesn't matter what others might say, whether they're qualified or professional advice or advice from a neighbor or a friend. Often, folks will take advice from a family member that has little or no experience.
Hmm. Yeah.
Um,
So, take what would you say to those who have thought about taking advice from a relative? So, in my situation, right? So, say I had $20,000 in debt, right? My parents have never had that much in debt, even though they're my first source of wisdom.
mhm,
They haven't ever walked in those shoes.
mhm.
So you would say in your circumstance, it's better to seek advice from a professional
Always,
versus who
always.
you go to for wise counsel necessarily all the time.
I absolutely would say yes, Steve. I mean, think of it this way: some of your wealthiest people pay for and seek advice from certified professionals, financial planners, folks that have a history and a record of keeping up with
Yeah.
finances and current event. It's no different than dealing with existing debt. If you think about it, you always want to seek advice of a professional as you would with a medical scenario. Finances is no different. Often they're very sensitive subjects that just aren't spoke about in an open forum. And, it takes a lot of guts, Steve, to realize that you need help, but more importantly, to reach out and get some professional help when you're dealing with someone, their credit, what they've been taught, the brainwashing that goes on from social media and television,
Yeah.
things of this nature play in effect.
So that being the case, how does one find with which path would best suit their situation?
I'm going to say that we always recommend our partners, our trusted partners, and that's going to be Redemption Financial Services, headquartered in Jacksonville, Florida. They have the best reputation from our experience in the industry. You can find them on the web at rfsus.com, Redemption Financial Services in Jacksonville, Florida. If you take a look at that particular company, as we've done our research, And we feel that we only couple with the very best in the industry, from the folks that provide the services to the company that we use to vet and enroll those our clients.
What do you like so much about redemption?
That's a fun question, Steve. I think you know the answer, and it's these folks are God fearing Christians. They have the moral fortitude and the spiritual maturity to deal with everything from "I can help you" to "No one can help you, but we can pray."
Amen.
It is a mind blowing experience, and you can see that if in the reviews on the website. It's quite amazing.
So if people were to Google Redemption Financial Services in Jacksonville, Florida, and look at those reviews, that's the ones you're talking about?
Absolutely.
Amen. Amen. Awesome. Well, Jerry, thank you so much for coming and giving us your experience today. I hope you all enjoyed the podcast. Tune into our next video. We're going to touch on the top ways to build and rebuild your credit in 2024. Thank you very much. God bless you all.
God bless.